That thing in your wallet, the bill you've never questioned, the currency that has been the bedrock of the American standard of living since before your parents were born. Right now, at this very moment, 3 governments on the other side of the world are working, methodically, deliberately, and with extraordinary patience, to make it worth less. Not worthless, not yet, but less. A little more, every single day. You felt something in 2021 when prices started climbing and nobody could fully explain why. You felt it again in 2023 when your grocery bill became a source of genuine anxiety, and most people accepted the explanation. Supply chain issues, COVID recovery, Fed policy. But there's a layer beneath all of that, a deliberate, strategic layer, and it involves gold, oil, and the quiet dismantling of the most powerful financial weapon America has ever wielded. In the next 15 minutes, I'm going to show you the monetary war that is running parallel to every military conflict you're watching on the news. A war with no missiles, no casualty counts, no breaking news alerts, but potentially far more devastating to your daily life than anything happening on a battlefield. Here's what we're covering today. First, what the petrodollar actually is, and why it has been the single most important reason America has been able to run the economy it runs. Second, how Iran, China, and Russia have built what I'm calling the axis of gold, a coordinated strategy to root around the dollar entirely, and replace it with something Washington cannot sanction, cannot freeze, and cannot control. And third, what happens to your savings, your mortgage, your grocery bill, and your retirement account if they succeed. This is not a conspiracy theory. This is geopolitics, and it is already happening. To understand why what's happening right now is so dangerous, you have to understand the deal that made America financially invincible for the last 50 years. It's called the petrodollar, and it is one of the most consequential financial arrangements in modern history, and also one of the least understood by ordinary Americans. Here's the short version. In 1971, President Nixon made a decision that shocked the world. He severed the dollar's connection to gold. Up until that point, every dollar in circulation was theoretically backed by physical gold in Fort Knox. Nixon ended that. The dollar became, in technical terms, a fiat currency backed not by a commodity, but by trust, by confidence, by the full faith and credit of the United States government. The world, understandably, was nervous. If the dollar isn't backed by gold, what is it backed by? And in 1974, Henry Kissinger answered that question with a secret deal that changed everything. The United States cut an agreement with Saudi Arabia, and subsequently with the broader OPEC cartel. The terms were elegant in their simplicity. Saudi Arabia and OPEC would sell oil exclusively in US dollars, not pounds, not francs, not gold, dollars. In return, the United States would provide Saudi Arabia with military protection and guaranteed arms sales. Think about what that meant. Every country on earth, Japan, Germany, France, Brazil, India, needed oil to run their economies. And to buy oil, they needed dollars, which meant every country on earth needed to hold significant reserves of US dollars, which meant demand for dollars was essentially guaranteed by the physical requirements of global industrial civilization, which meant the United States could run deficits that would have collapsed any other economy, could borrow at low rates that would have been impossible for any other country, could fund its military, its social programs, and its global influence on terms no other nation could access. The petrodollar wasn't just a currency arrangement, it was the invisible foundation of American global supremacy. It's why we could spend $2 trillion in Afghanistan without triggering hyperinflation. It's why the dollar has remained the world's reserve currency even as our national debt climbed to $35 trillion. As long as the world needed dollars to buy oil, the dollar was safe. Now here is where it gets alarming. What happens when the world finds a way to buy oil without dollars? For decades, Washington's strategy to discipline adversarial governance was elegant and brutal. Cut them off from the dollar. Sanctions, swift exclusions, asset freezes, trade restrictions. The message was always the same. Cross us, and we will cut you off from the global financial system, which runs on our currency. It worked for a long time. It worked extraordinarily well. And then something shifted. Iran, Russia, and China, 3 governments with very different interests but one shared grievance, began to ask the same question. What if we just built a system that didn't need the dollar at all? Let's start with Iran, because Iran's situation is the most instructive. Under the weight of US sanctions, Iran was effectively locked out of the global financial system. It couldn't sell oil through international exchanges. It couldn't receive wire transfers through SWIFT-connected banks. On paper, its economy should have collapsed. But Iran found a workaround, and that workaround has become the template for the entire axis of gold strategy. Iran began selling oil directly to China outside of any dollar-denominated exchange. The transactions are settled not in US dollars, not in euros, but in physical gold and Chinese yuan. Let's be precise about what this means. This is not a minor trade workaround. This is a direct, functional bypass of the petrodollar system. Oil, the commodity that created and sustained dollar hegemony, is being bought and sold without a single dollar changing hands. And China isn't just doing this with Iran. China has been systematically building alternative payment infrastructure for years. The cross-border interbank payment system CIPS is China's direct answer to SWIFT. It allows international transactions to be settled in yuan, completely outside of US oversight or control. Russia, after its exclusion from SWIFT in 2022, accelerated its own pivot. The ruble's partial backing by gold, the shift of energy exports to yuan and gold settlements, the deepening of Russia-China financial integration, these weren't panicked reactions. They were steps in a strategy. And here's the number that should stop you cold. Central banks globally purchased more gold in 2022 and 2023 than in any two-year period since the end of the Bretton Woods system in 1971. The buyers are overwhelmingly Eastern, China, India, Gulf states, Central Asian economies. What are they saying? In the language of capital, we are moving our reserves out of dollar-denominated assets and into something that Washington cannot freeze, cannot sanction, and cannot inflate away. Every ounce of gold those central banks buy is a vote of no confidence in the US dollar as a long-term store of value. This is the axis of gold, not a formal military alliance, not a signed treaty, a coordinated, patient, strategic migration away from dollar dependency and toward a commodity-backed alternative that the United States has no lever to control. Now let's talk about what this does to you. Here is the mechanism that most financial commentators gloss over. It connects geopolitical chess moves in Beijing and Tehran directly to your bank account. Approximately $6 to $7 trillion US dollars are held outside the United States, in foreign reserves, sovereign wealth funds, and international investor portfolios. These dollars are held offshore because the world needs them for international trade. Oil, commodities, and debt are all denominated in dollars. You hold dollars like a ticket because you need it to get through the door of global commerce. Now imagine the door changes. Imagine oil trading in yuan, gold-backed digital currencies, or a BRICS settlement system. You no longer need dollars. What do you do with the dollars you're holding? You sell them. Trillions of dollars begin flowing back toward the United States, the country that issued them. There's nowhere else for them to go. What does it mean when dramatically more dollars chase the same amount of goods? Every first-year economics student knows this answer. Prices go up, not manageable inflation. We're talking about inflation that rewrites the relationship between wages and prices, the kind that makes retirement savings feel inadequate almost overnight. The kind that turns a middle-class income from comfortable to barely sufficient. This is not a theoretical model. We have historical examples. When the British pound lost its reserve currency status in the mid-20th century, Britain experienced years of economic turbulence, devaluation, and a painful restructuring of its global position. And the pound's displacement was gradual, orderly. A rapid de-dollarization scenario, triggered by a geopolitical crisis, would be orders of magnitude more disruptive because the dollar is far more deeply embedded in global finance than sterling ever was. Your savings account is denominated in dollars. Your mortgage, your social security payout, your 401k, unless you've specifically diversified into foreign assets or commodities. Every financial instrument you own is priced in a currency that is quietly, systematically being challenged for the first time in 80 years. That's why these matters, not because of what's happening in a vault in Beijing, because of what happens to your purchasing power when the vault in Beijing decides it doesn't need dollars anymore. Now layer on top of everything I just described a hot war. The United States military is currently conducting active operations in the Middle East. Every Tomahawk cruise missile costs roughly $2 million. Every carrier strike group deployed costs tens of millions of dollars per day to operate. The logistics, the fuel, the munitions resupply, the cash register never stops. And every dollar spent on kinetic military operations is a dollar added to a national debt that the world is increasingly skeptical about. Here is the compounding problem. The axis of gold isn't trying to defeat the US military. They know they can't. Iran knows it can't sink an aircraft carrier. China knows a direct military confrontation with the US today carries enormous risk. Russia's military has shown its limitations in Ukraine. So, they're not fighting that war. They're fighting a war of exhaustion on the financial front. Every month, America spends billions projecting military power in the Middle East. It adds to a debt load that erodes confidence in treasury bonds, the very instruments that underpin dollar hegemony. While Washington fires $2 million missiles, Beijing buys gold. While the US deficit expands to fund the defense budget, China, Russia, and their partners quietly accumulate the one asset that has stored value for 5,000 years and cannot be printed, sanctioned, or inflated away. It's a judo move. They're using America's own military ambition as the weight that pulls it off balance. So where does this go? Let's look at the three realistic scenarios. Your financial decisions may depend on which scenario you believe is most likely. Scenario 1. The dollar holds slow erosion, not collapse. This is the most probable near-term outcome. The dollar doesn't collapse overnight. Reserved currencies don't die in a day, they fade. The pound declined over decades. In this scenario, the dollar gradually loses market share as a reserve currency. It goes from 58% of global reserves to maybe 45%, then 40%. America retains significant financial power but has to pay more to borrow. Interest rates structurally stay higher. The deficit becomes more painful to service. The middle class feels it in persistently elevated inflation and slower wage growth. Scenario 2. The accelerated pivot. A crisis forces the timeline. A major geopolitical event triggers a rapid acceleration of de-dollarization. Countries that were quietly building alternatives suddenly move quickly. The offshore dollar pool starts contracting fast. The Fed faces an impossible choice: raise rates to defend the currency and trigger a recession, or let inflation run. This is the scenario that wipes out savings, that turns a comfortable retirement into an anxious one. Scenario 3. Dollar dominance reasserted. The United States moves decisively to reform the global financial architecture on its own terms. A digital dollar ACBDC gets deployed internationally, offering the efficiency of blockchain settlement with the security of US backing. America strengthens its alliances, prices more commodities in dollar terms through diplomatic pressure, and the axis of gold runs into its own internal contradictions, because China, Iran, and Russia don't fully trust each other either. The honest answer is that elements of all three scenarios are probably true simultaneously. The dollar won't collapse, but it will continue to weaken, and for ordinary Americans, the difference between a strong dollar and a merely adequate one is measured in grocery bills and retirement security. I want to be very clear. I am not a financial advisor, and nothing in this video is financial advice. I read geopolitical and economic data carefully, and I can tell you what questions you should be asking your financial advisor. The question is not, should I convert all my savings to gold? That's panic thinking, and panic decisions are rarely good ones. The question is, does my current financial position assume a stable dollar indefinitely? Because if your entire retirement is in dollar-denominated US equities and fixed income, you are fully exposed to dollar purchasing power risk with no hedge whatsoever. Historically, periods of dollar weakness have benefited commodities, gold, oil, and agricultural assets. They've benefited international equities, particularly in emerging markets. They've benefited real assets, property, infrastructure, because hard assets tend to hold value even when the currency they're priced in doesn't. These aren't exotic or radical positions. They're the basic diversification principles that financial planners have recommended for decades. They just become more important in an environment where reserve currency status is actively being contested. Ask your financial advisor about your currency exposure. Ask about commodity allocations. Ask about international diversification. These are conversations that the axis of gold has made urgently relevant for the first time in a generation. There are two wars happening right now. One you can see, you can watch it on the news. You can track the airstrikes on a map. You can count the ships in the Persian Gulf. You know its name, its geography, and its daily toll. The other war has no front line, no generals, no press briefings. It's fought over in the gold vaults of Beijing and the back-channel oil deals of Tehran. It's fought in the architecture of payment systems that root around the dollar. It's fought over in the patient accumulation of a commodity that has been money longer than America has existed. And unlike the visible war, this one doesn't end with a peace treaty or a troop withdrawal. For 80 years, the dollar's dominance was so absolute that most Americans never had to think about it. The currency in your wallet simply worked with a stability and purchasing power that was, in global historical terms, extraordinary. That era is not over, but it is being contested, for the first time, seriously, by adversaries who are patient, well-resourced, and motivated by decades of frustration with American financial leverage over their economies. The axis of gold is not going to defeat the dollar next week or next year, but the trajectory matters. Erosion is not collapse until it suddenly is. The question I'll leave you with, and I genuinely want to know what you think. So drop it in the comments. Is the dollar's dominance a permanent feature of the global order, or is it a historical moment that, like all historical moments, eventually ends? And if it ends even partially, even gradually, are you positioned for it? Think about it. Talk about it, because the financial conversation that most Americans are not having right now is exactly the one that will matter most in the decade ahead. Hit subscribe if this kind of deep dive analysis is what you're looking for. Every week we cover the economic and geopolitical forces that shape your money, your career, and your country without the noise. This is Money History. The axis of gold is moving, and the dollar is watching.